All right. So accrued expenses handled the same way as the accrued revenues go. Okay. It's just you just have to figure out the accounts that you're going to impact when you do these entries. So the costs incurred in the period that are both unpaid and unrecorded. So here is an example. Fast Forward pays its employee $70 per day, or $350. Huh? Yeah, $70 per day, or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. So at December 31st, it's a Wednesday, so there's 3 days salary that are owed at the end of the year. Don't let this throw you off. That equals, so they're talking about Monday, Tuesday, and Wednesday of that week. They're telling you that this is still owed and it should be recorded at the end of December. It says the adjusting entry increases the liability, salaries payable, and increases the salaries expense account for $210 with the following journal entry. Does everybody understand what they're doing?
Yeah, because you have to show you're paying those people for the last 3 days of the year,
Mm-hmm.
and you're paying them the $210.
Mhm.
You have to record showing you paid them.
Yep. So the week before, they got paid on that Friday, right? And it was within the month though.
Right.
But they won't get paid again for 2 weeks. And it's going to be for that following 2 weeks. Okay? So because they don't get paid again for 2 weeks, the company has to say, well, wait a minute, we need to record those 3 days. And that seems as if you want to say that's not even a big number. Like, why would they do that? But if you multiply that times, thousands of employees, that dollar amount can actually end up being very significant. So every company does some sort of accrual, especially at the end of the year, to record salaries that are in an off week for payroll. Okay? And just in this particular situation, they're going to record the 3 days for Monday, Tuesday, and Wednesday. So the entry is going to be for salaries expense of $210. Can you go ahead and make me the 2 journal entries? I'm sorry, the 2 T tables.
Expense table?
It is going to be salaries expense and salaries payable, yes. So salaries expense is an expense account. Expenses are part of DEA. And then salaries payable is exactly what it is. It's a liability account. So it's part of the CLR bucket. Liabilities are minus pluses, expenses are plus minuses, and that is shown on the board. So in this particular situation, we are trying to record salaries and expense of $210. So does my salary expense account go up or go down? It goes up because we want to show additional expenses of $210. But we also want to show that we owe somebody this money because no cash has been utilized, right?
Right.
So our salaries payable goes up. Before we didn't owe anybody. Now we owe somebody $210. So we went from 0 to 210. Then accrued salaries expenses. So they're just showing you what the original journal entry was. And then they're going to show you what the balance is in those particular accounts. And then they're also going to show you what financial statement that transaction hits. So salaries payable now has a balance of $210 on the balance sheet because liabilities and assets go on the balance sheet. This is a liability. And then it also is going to show you that the expense account is impacted. It goes on the P&L or the income statement. So the balance in that account is going to be $1,610 to show that we had $1,610 in expenses for salaries. This example here is for future payments of accrued expenses. Accrued expenses at the end of one period result in a cash payment in a future period. So fast forward, recorded accrued salaries of $210 on January the 9th of the next year, right? So we already closed all of our books for December 31st. Now we're moving on to January when an actual payment is made. So remember, 2 weeks went by, and now they're actually getting paid for the salary that we already expensed. So on 1/9 of the next year, the following entry will reduce the accrued liability, salaries payable, and record the expense for 7 days' work in January. So the best thing about this situation, where in this situation cash is impacted. Why is cash being impacted now?
Because we have to pay it.
Because we have to pay these people, right? So
So cash is going down.
cash is going to go down simply because now we have how many days of pay? How many days are in a work week? No, 5 days in a work week. Right? This is a Monday through Friday job. They didn't tell us, but it is a Monday through Friday type of job. So, well, yeah, we knew that because if not, Sunday would have counted and it would have been 4 days. So since it was only 3 days, we know that this is Monday, Tuesday, and Wednesday from the previous, from the beginning problem.
You wanna make another cash then?
Go ahead and make another one up there. So, on January the 9th, we have 2 weeks pay, right? So that's 10 days at $70 a piece. So that is $700. So we paid out $700 cash. Now, in a perfect world, if this were not between two pay periods or 2 years, we would just have one entry for $700. And what would be the offset account?
Salary payable?
It wouldn't be a payable.
Expense.
It would be an expense. So if we didn't have a situation where we had to now split our journal entry between two different accounts, because we have to go back and we have to fix our payable account. Because do we still owe that money?
Yeah.
Not as of the day that we paid that $700, right? If this were a perfect world, there would never have been anything in salary payable anyway. It would have just been $700 cash, $700 salary expense. If we were not going across two different pay periods. Does that make sense? The only reason why this entry is being created this way is because we're about to go across two different pay periods. If this were just in the middle of October, we would only have two different accounts impacted. It would just be cash for $700 and it'd be salary expense for $700, period. But because we're in a situation where we're going to go across periods, we have to now fix the original entry that we made. So as of January the 9th, the money that we owed on December 31st is null and void. We have now, we've accounted for the money that we owe people. So we want to do what to salary payable? Do you want to show that there's a balance in that account now?
You wanna show that there's zero.
You want to show that there's zero, right? So how do you show that there's zero?
Put 210 here.
You put 210 there. Okay, so we have a credit of $700 and we have a debit of $210. Is our account balanced?
No.
Why isn't it balanced?
Because you got 210, 700,
So-
210.
Yep.
Yeah.
So then
Okay.
what happens to the remaining balance that we have? So we have 3 days that we already accounted for, right?
Right.
So now we need to take care of the other 7 days that they worked and we just paid them for. So then we got to know, well, what account does that impact? It is. So it's just straight salary expense. What's the dollar amount that I'm going to put there?
700.
Why would I put 700?
You want 490.
You do want 490.
That you want to pay them for the 7 days that they work.
We want to pay them for the 7 days that they work because
that 210 is already the 3 days we pay them.
yep. This 210 is for December, what was that, 29th, 30th, and 31st, right?
Right.
And this is for January 1st, 2nd, 3rd, 4th. Ooh.
No,
Not
January
the
1st
3rd,
is a holiday.
That was the, well, I think they still got paid for it. So this was Thursday, Friday, Saturday, Sunday, Monday. So Monday would be the 5th, right? 5th. So that's Monday, Tuesday, Wednesday, Thursday, Friday. So 1, 2, 3, 4, 5, 6, 7 days. Right?
Right.
Does that make sense?
Yes.
So we had to pay them for 2 whole weeks. So the 2 days they were left from the week before, which was the beginning of the new year, and the 5 days of this current week. So that's 7 days we had to expense that. We gave them cash. So you have to think through everything that's happening so you know which accounts are going to help it to balance. All right? And now, do our debits equal our credits? Well, not yet, because
You want the 490 here?
do you want the 490 there?
No, I don't.
Where do you want the 490?
Here.
Why? Just because I asked why doesn't mean you're wrong.
Because, yeah, because this, yeah, I want it. Because then it'll be equal.
Okay, yes, it will be equal, but there's any other reason why you want it there?
Because expenses is part of the EDA, so it's audited.
Yep, because expenses is part of DNA, so it is a plus minus, and we want to increase that account. So what's my balance in salaries expense now?
700.
Isn't that what it should be, to show that we expense $700 for that pay period, right? And then what's my balance in in salaries payable?
0.
And do we want it to be 0?
Yes.
Do we owe anybody anything anymore?
Nope.
Correct. And then cash has a decrease of $700. We don't know the balance because there's so many other transactions. So that is correct. That makes sense to everybody?
Wait, that's a different question.
Yeah, I just saw that. Okay, so this is a new one. I'm just gonna erase
Want me to erase all these?
these. How many accounts do we need for this? So what are my account numbers? Yeah, you can go ahead and erase it, because we can look at all of the accounts that are gonna be impacted first before we do the
All of
numbers.
them?
Yeah, erase
Or
all
you
of it.
leave like cash, rent?
It's up to you. Yeah, erase everything. Because we're gonna talk about what accounts are gonna be impacted before we talk about the numbers this time. All right, so for each separate case below, follow the 3-step process for adjusting the accrued expense account. Assume no other adjusting entries are made throughout the year. So it says at year end, salaries expenses of $5,000 have been incurred by the company, but is not yet paid to employees. So when we're looking at this particular question, what are all of the accounts that are going to be impacted?
Cash.
Put cash up there. So cash is going to be impacted,
Expense.
right? So cash is one. And then what's the next one?
Salary expense.
Salaries expenses is going to be impacted. And then what's the other one? No.
Salaries payable.
Salaries payable. And there is a second problem up there, which is the one that you're talking about, but we're not going to do that one yet. All right. So we know what accounts are being impacted. So let's go ahead and take care of our plus minuses and DEAs. So the D's and C's are in the exact same place that we're going to be regardless of the type of account, right? So debit is always on the left-hand side. Credit is always on the right-hand side regardless. All 6 look the exact same way in regards to debit and credit. And then we're going to do our plus minuses. Cash is a what type of account?
Asset.
Cash is an asset. Salary expenses, what type of account? Salaries expense.
It's expense.
It's an expense.
So it would be.
Salaries, go ahead.
Plus minus. wouldn't
Yep.
it?
Salary payable is what type of account? It is a liability.
So it'd be a minus plus.
All of those payables accounts are liability accounts. So asset plus minus, expense plus minus, liability minus plus, right? And you don't have to guess. You already write those down at all times, so you'll know. DEA, drawing expenses, assets are all plus minuses. CLR, clear, are all minus pluses. Okay? So it says at year end, salaries expenses of $5,000 has been incurred by the company, but is not yet paid to employees. So as of right now, we had $0 in our salaries payable, but we want to show the $5,000 that they're saying they have incurred in salaries, right? So what is going to happen to my salary payable account?
It's gonna go up 5,000.
It's going to go up by $5,000. And then what's going to be the offset to that?
Cash.
Have we paid them? Nope.
It's gonna be our salary expense.
Yep. And why is it going to be salary expense?
Because we owe them.
And we want to show that expense, right?
Right.
So when I'm creating my financial statement and I show how much money I made, and I want to say, okay, well, what are all the expenses that I incurred in order to make that money? I need to show I paid payroll, right? So I'm going to show, even if I didn't physically pay them with cash, I still incurred that expense. So if I made $10,000 and it cost me $5,000 in salaries, so that means that my net profit was what? $5,000. So do you see how important it is to make sure that you categorize this stuff correctly in the right buckets? Because what if I never recorded the $5,000 of salary expense?
You showed you didn't pay?
It's gonna look like I made all this money. It's gonna look like I made all this money, but in reality, I only made $5,000 total. Because I had to pay $5,000 of that money out, period. Right? So it's very important to keep your revenues and your expenses in the correct period. All right? So that was the original entry. So we have our salaries expenses of $5,000 and we have our salary payable of $5,000. So then we had this second problem, interest payable. What accounts are going to be impacted?
Mortgage.
Mortgage.
Is it mortgage or capital or like revenue?
Mortgage payable.
Yeah.
I think this particular instance is going to be, okay, so we have holds a mortgage payable that has incurred $1,000 in annual interest that is neither recorded nor paid. The company intends to pay the interest on January the 3rd of the next year. So mortgage payable is one. And why is it mortgage payable?
That's what it says.
Nope. Well, yes, but what's the other reason why it's mortgage payable? What is mortgage payable? It's the balance of the mortgage, right? And that we owe somebody. So,
it's a liability.
yep, it's a liability. So if you own a house and you still have a mortgage on it, that is a liability for you and your personal financial statement, right? Because you owe somebody whatever the balance is of that mortgage. So we have mortgage payable. What are our other two accounts that are going to be impacted by these transactions?
Interest.
It's going to be interest. That is an expense account, interest expense, right? Again, this is an expense that we incurred in order to do business. All right, and then what's the last account type that's going to be impacted? It is going to be cash. Because on January the 3rd, what are we doing?
We're paying.
The
Yep.
interest.
We got to pay the interest. So we're going to do that on January the 3rd. Yep. You going to use the cash that's down there?
Yeah. I mean, do you want to make a new one?
No, that's okay. All right, so let's do our entry. So what do we want that account balance to be?
0.
Nope. That is the interest payable.
Oh,
1,000?
Yep.
yeah, we want to, yeah, 1,000.
So at the end of December, we want it to be $1,000. It says at December 31st, the company holds a mortgage payable that has incurred $1,000 in annual interest. So we want to show that interest payable because we owe them. And when are we going to pay them?
December 31st.
Nope.
Oh, January 3rd.
Yep, we're going to pay them January 3rd. So if we're not going to pay them to January 3rd, how much do we owe them at December 31st?
1,000.
At $1,000,
Yeah.
right? So we incurred it for the whole year. Our financial statements should be created as of December 31st, whatever the year is. Since we're not going to pay it until January the 3rd, on December 31st, we owe somebody that money. That is a payable for us. Remember, payable is what we owe. Receivable is what we receive in. Okay? So actually, we don't need mortgage payable. We need interest payable. Sorry.
You still want interest expense?
Yes. So it should be interest payable.
Wouldn't that go up 1,000?
Yep. And then what happens with interest expense?
Goes up.
Yep. When you create your journal entry, what goes first?
Debit.
The debit. So interest expenses are debit. So that is listed first. Interest payable is our credit. And that is listed second. That's it. So we're going to go on a small break.